What up, guys? Hope everything is going well on this Veterans Day. I wanted to look at the price of gold. Gold had an interesting morning today where it was trading at 1285, and then all of a sudden, late morning, early afternoon, you saw a huge reversal in the price of gold, where you saw it earlier, it could have been like 1283, 1284-ish, and then it went down over 10 bucks over to 1275. And I follow the gold market carefully. I follow the 10-year yield carefully. I follow the yen carefully. And what I noticed was a strong reversal in the 10-year yield compared to earlier in this week. Right now, the 10-year yield is up to 2.4%. And in one of my Seeking Alpha articles, I'm going to post some of the articles, by the way, that I wrote and published this week, so you could take a look what's going on in my mind, and you could comment on those articles as well if you have a Seeking Alpha account. But anyways, the 10-year yield is the most important, in my opinion, for looking at the gold market. And also the Japanese yen, I've talked about it, and there are other currencies as well. You could look at the Aussie dollar, you could look at even the Swiss franc, and a few other gold mining currencies, such as the New Zealand dollar as well. But I like looking at the 10-year yield and the Japanese yen the most, because that's the most sensitive to negative real interest rates. And same thing with gold. Gold is very sensitive to negative real interest rates. And when you're talking about interest rates, inflation, you're looking at the globalist view of determining inflation. We're not looking at the Austrian view. I come from the Austrian perspective, but I can't look at it when analyzing the markets. That's just the reality. So gold prices went down 10 bucks. 10-year yield is 2.4. Saw a huge reversal. I had some TLT puts. I got rid of them. I may get back into that trade. I also have bearish positions on 10-year bonds in the futures markets via the option market. So basically, I sold some bearish call spreads. And right now, that's working in my favor. It wasn't earlier this week. 2 weeks ago, it was working. And now it's working again. Now, how should we look at gold moving forward in the next month? Well, the fact is, even though the commercial hedgers are starting to get somewhat bullish on the 10-year yield, we haven't seen the data for this week because of Veterans Day and also the Japanese yen. Last week, the commercial hedgers were long over 150,000 contracts. Let's get this straight. 150,000 contracts. That's a large position. If you look at the historic high, it's closer to like 185,000, 170 some thousand. So we're getting close to the most longs in the Japanese yen. I mean, once you get there, I would expect the market to reverse in terms of gold prices and in terms of the 10-year yield, in terms of the Japanese yen. They would all be bullish. Gold, yen, bonds, 10-year bonds, or 10-year yield bonds. So the next month, we noticed that there's a FOMC meeting, December 13th. And what I've noticed more times than not in this interest rate cycle is that running up to the Federal Reserve rate hike, you tend to see gold prices go down, you see the 10-year yield go up, you see the dollar rally. I expect all of these three things to occur. This doesn't mean that the stock market's going to rally up into that point. I'm just saying that based on what I've seen the last 3-4 times they've raised the Fed funds rate, you've been seeing the same pattern. And shortly after they raise rates, then gold goes up. And I've talked about this phenomenon, and I haven't created this concept, but you could look at it online. Don Harold talks about it. There's Mike Norman that talks about it. higher rates means higher inflation, right? You're raising the cost of credit, basically, right? And this is not looking from an Austrian perspective, not looking from a Keynesian perspective. I'm just looking at what people from different perspectives are saying who tend to follow these markets more in depth than I do. And when you have different people of different backgrounds talking about this, then we should take a look at it. And we've seen that, right? They've raised the Fed funds rate since December 2015. Gold was, what, 1045? Where is it now? 1270? I expect gold to go down because of buy the rumor, sell the news aspect, right? They're going to buy up the dollar, they're going to sell the yen, they're going to sell bonds, they're going to sell gold. But after that, it should go back up, right? And the Fed funds rate, by the way, is going to be 1.5% around. And after that, they're going to have, what will the 10-year yield be? That's the interesting point, because remember, the yield curve needs to be positive for this market to continuously go higher and for the economy to improve. And I believe it will. Despite the tension with the tax cuts and short-term selling right now that we're seeing, the tax cuts will come. But it's not going to be as great as the president had envisioned. Unfortunately, Congress is so dysfunctional, we're not going to get the best tax cuts package out there. And speaking of this tax cut package, it's just going to create more volatility until both sides come up with a solution. Now, when will this occur? I'd say probably sometime after the summer of next year. I mean, Reagan, it took him, 3 years into it? It took Bush, 2.5 years? It's going to take Trump the same time frame. And he better do it before the election of the Democrats next year. That's what it looks like the trend is going towards. But anyways, guys, let me know what you think is going to happen with gold, what's going to happen with silver, what's going to happen with the Japanese yen, dollar, etc. I'll do a video on Bitcoin. It'll be closer to when the CME launches the Bitcoin futures contract. That should be very interesting. And then you're going to have limit downs in Bitcoin trading, but you don't have that right now. There's no limit down. There's no suspension of trading. It just keeps on going on. So let me know what you guys think, and I'll talk to you later. Thanks. Bye.